So it's a real pleasure to introduce Tim Connors. He's been a great advocate for CIS. I've mentioned him a few times during the day and a half, or the day we've been together. But Tim is a regular on the Forbes Midas list of top tech investors. His PivotNorth funds provide early-stage venture capital to computer scientists who not only want to disrupt important markets, but do so in ways that advance ESG principles and improve the lives of the underserved and poorly served. He's a hands-on coach to the founders he supports. He's a great catalyst for CIS, improving the way we do things, and he applies the same thoughtful and provocative style as a leading Catholic layman, using his STEM brain for the greater good. We have no bigger advocate or better friend than Tim Connors. So Tim, I know this is going to be a great panel. Thank you.
Thanks so much. Thanks so much. Well, it's great we can go last. We can summarize it all. So it'd be great if each of you can introduce yourself, and stealing one of the best questions from the conference, what's the one thing you would do if you were Pope?
Hi, everyone. Dave Helgerson. I'm a managing director at Hamilton Lane, and together with Jackie Rantanen, who was just up here, we co-head the impact strategy at Hamilton Lane, and also focus on kind of direct equity investing there. So in our investment committee and our responsible investment committee, and have been at the firm for just about 20 years. And I also want to say thank you to CIS for an amazing conference. This has just been great. So thanks, Tom and Scott, and for including us. No one's ever asked me that question before. That's the latter. And I think that what I would say, and what I've heard here today, is be true to your mission. And I think that's really, to me, what kind of summarizes what we've been talking about. And I think it requires, it's sort of easier said than done, right? But I think getting people and organizations to really step back and think about what their missions are and put that into practice is probably the thing I would keep driving home and try to enable more.
Awesome.
Hello, my name is Kayoko Lyons, and I'm the Director of Investments for the Missionary Sisters of the Sacred Heart of Jesus. I work here in Chicago, where our finance office is, but our congregation is a global order. We work in 16, or actually it might be 17 these days, different countries. Our mother house is in Rome. I joined the Missionary Sisters of the Sacred Heart in 2019 as their Director of Impact Investments. So I helped them begin their impact investment journey and build a portfolio, a global portfolio, which I'll share more about on the panel. But we're a very small office. It's really myself and our CFO here in Chicago, and so I work with him also on our broad investment portfolio, so not just the private impact investments, but also our public investments as well. And as for that question, that's a tough one. I guess I would hope to never be in a position of such power and authority, but I would say I would just encourage everybody to put yourselves in the shoes of others and really work to just spread kindness to everyone in the world, because we know we need that these days. Awesome. Thank you.
Awesome. Bernard?
Yeah, hello everyone, Bernard Brennickmeyer. I'm the European on the portfolio, on the panel this evening, and excited to share a little bit about the impact journey we've been on. We started impact investing back in 2013 and have lots of scars to prove it. It's an exciting, challenging, difficult aspect to our overall portfolio. Just to give perspective, and I think we're going to come back to this a little bit on definitions, what is impact is, almost everyone has a slightly different definition of the term from the person sitting next to them. And so I think to really think about that carefully for each organization is really a starting point for most journeys into impact. And coming back to the earlier discussion, it is a journey, and you start off small and you take step after step after step towards the impact you want to achieve. And that's the journey we've been on inside of the Porticus organization. Porticus is known to many of you as a philanthropic organization active in church topics, but also the environment is a big focus, as is education, as is social cohesion, and that on a global basis. So my role for the last 8 years has been managing the investment portfolio and really building and developing what we call our responsible investing policy, and then our small sleeve of true impact, where additionality is the key focus.
So Pope Bernard, what would you, first act as Pope?
My first act as Pope would be to define the impact from a Catholic perspective.
Nice. Let's start there. So it's word soup, right? ESG, SRI, Mensurum Bonum, USCCB investment guidelines, a negative screening, right? Some of the special interests are trying to co-opt some politicians to make it seem like a bad thing, not a good thing. So define impact investing for us. Bernard, why don't you start?
I'm happy to start. So for me and for our organization, impact really has two things that typify it. One is intentionality. It's not something you were doing already. It's something you're doing explicitly with an impact goal. And then the really tricky bit is additionality, in that it is something that where your capital makes a difference. If your capital wasn't there, things would be different. It wouldn't be backfilled instantly by some other investor, by somebody else doing the same thing that you have now chosen to do. And so those two criteria, if you're using that as your definition, you get a relatively narrow definition of impact.
And I would just add to that we really think about impact investments as having an intentional desire to have a positive social or environmental benefit. So for us, we do ESG, SRI, negative screens, impact investments, everything, but our impact investment portfolio, when I talk about it today, I'm really talking about the private investments where the companies or the organizations or the funds we're investing in have a deliberate, intentional purpose to create additionality or additional positive social or environmental impact. And for us, we try not to get too bogged down in all of the terminology, because really, I just think at the end of the day, we're all trying to do the same thing. Everyone wants us to have a more healthy and prosperous planet, and for people to all have the ability to live fulfilled and dignified lives. So we try, I know there's a lot of polarization of all these terms in the US, but when we really focus on the values and what we're trying to achieve, I think there's mutual goals on both sides.
And we would agree with those definitions as well at Hamilton Lane. I think the one thing we would kind of add, maybe tying back to my earlier comment, is within our impact fund, we really look for companies that are mission driven. So we're making direct investments into companies that are mission driven and whose revenue is growing alongside that mission focus. So we look for the other key term we look for in addition to intentionality, and additionality is alignment. Alignment with the impact mission and the business mission, so that they're intertwined and they're sustainable. And we also kind of use the term collinear. So we want to see companies that are going to continue to grow, build revenue, and in that growth, continue to achieve more and more to deliver on that mission or theme. So the alignment, we think, is really critical and part of that process.
So Dave, some people think, well, gee, if you're not a real capitalist, if you care about anything other than next quarter's profits, right? Do you give up return, or do you get return by thinking about stakeholders versus shareholders?
Well, I love that question, because I am a capitalist and an impact investor, and we believe and we think we're delivering some results to prove that we can do both. And some of that comes from the fact that we've been doing this for 20 years in different ways with different strategies. We've also kind of done that by stepping back to look at kind of the key themes that we think are most interesting to invest in from an impact area, whether they're environmental or social. And I think also stepping back, we're seeing a world that's going through a lot of change and has a lot of challenges out there, whether they're environmental or social. And we see private equity historically as a great vehicle for driving and delivering opportunities around change. And that could be through a venture portfolio or a more mature company portfolio. But that's what we really look for, is opportunities to really drive change to solve the problems that we see today. And so from that perspective, we step back and define themes in our strategy. That includes companies that are helping to deliver on the energy transition path to create hopefully a less fossil dependent environment. and reduce CO2 emissions. And so there are a lot of companies that help to do that and support the infrastructure needs, whether it's through grid stability or solar power generation or all of the support infrastructure that's going in to transition our transportation mobility systems to electric. We look at companies that are more sustainable, that support, let's say, better, more sustainable waste management or the circular economy. And we look at healthcare companies that are delivering more access to healthcare to people that don't have it or better results in healthcare, and look at things around the community development and education thematic. And those are just a few examples, but they all represent examples of companies that are growing, that are delivering great value to their investor base, but also to their stakeholders, to the customers, to the community around them, and that's really what we're looking for as we invest.
Kayoko, returns or impact or both?
Both. So we look at not just a risk-adjusted return, but also we add a third dimension, which is impact. And so we are able to take a lower risk-adjusted return if there is a higher impact. And so we do have separate pools of capital, and we have a pool of capital which is a concessionary bucket where we say that capital preservation is just the goal out of this portfolio. Because in our experience, a lot of the impact investments that our sisters wanted to make, there was a direct correlation between the benefits accruing to the end user who we were trying to help. In the case of our investments, a lot of our work is supporting refugees and immigrants around the world, and a direct correlation between benefits to them and the rate of return we are getting. And what I mean by that is if we offered a lower return investment that would not be commensurate, it wouldn't be defined as a market rate return compared to the level of risk, that savings that the organization had, that 1 or 2% less that they're not paying back to us, and this is for a note, most of our portfolio is debt, that savings was passed directly to the borrowers themselves. So for example, we did a loan to an organization, the International Rescue Committee, which is one of the refugee resettlement agencies, and they started a program to work with the Afghan refugees that had arrived here over the last year, and they passed on that savings to offer 0% short-term loans. Sometimes they were $200, $300, just so that these individuals could get a credit score. Because as maybe many of you here don't know, but if you don't have a credit score, you can't do a lot of things. You can't get a credit card, you can't set up your Wi-Fi, you can't set up an electricity account, you can't rent anything. So these 0% loans enabled these new immigrants to the country to get a credit score and build their lives. So in cases like that, where we see that a reduction in the rate of return will directly increase the benefit to the end beneficiaries, we are willing to do concessionary or below market returns. And that's mostly been on kind of social issues. Whereas on the climate side, as Dave pointed out, I think market rate of return, it's much easier to think about how you can have your cake and eat it too. You can have positive impact benefits for the planet and populations, but also have market rate of return. So we have both in our portfolio.
Maybe just adding on to that, that we have also seen that negative screening doesn't impact your returns. It's perfectly possible to have very solid, very acceptable returns with all of the screening and that we've talked about here from a Catholic perspective, but going further also to really screen on human dignity topics that companies you're invested with are maintaining the highest standards across more than typically just the Catholic, the Catholic issues. Inside of our impact investing sleeve, which is a very small percentage of our portfolio, in our quest for additionality, we've taken more risk, and that was very knowingly. And so we clearly defined a risk budget for our impact sleeve, and have found that if you're doing first-time funds, if you're doing things in emerging markets, if you're going to where the need is greatest, you will find risk, and that does manifest in lower returns. And that's okay, and that's a trade-off that the board, in that sense, of every organization needs to make. And it's a good policy to write it down, be very clear that everyone understands what the goals are of which portion of the portfolio, and then everybody can go to work and make the best out of it.
So historically, if you're a foundation, a lot of times your corpus investments wouldn't necessarily align to the mission specifically. That's getting better. And then you normally take your 4 to 5% payout, and you do nonprofit granting, right? But now you can do program-related investments and invest not just in nonprofits to help solve a big social problem, but you can invest in tech startups and other things. If you're running a foundation, how would you think about how you'd allocate that 5%? How much would you put towards nonprofits? How much would you put towards tech-enabled impact companies? And what would be the right blend to have the biggest impact?
Well, that's a great question, and maybe if I'm taking a stab at it, but I think that a lot of that comes back to the mission of that organization, I think, and what you're ultimately trying to achieve. There's so much need that exists on a social and environmental level that I think that you're delivering some value in both cases. One of the things that we like about delivering social and environmental impact results from the investment side is that you're getting that capital back and you can do more with that. So it's compounding that growth, and you can continue to grow and deliver on the overall organizational mission and the goals of that 5% by putting it into companies that are going to return more back to you. So I also think that there's a real need for nonprofit support. You can't take and frankly, a number of these institutions in the room are critical to the survival of those organizations. So, I wouldn't want to see capital move out of those spaces either. And so I think there's a real healthy balance that you have to come up with. And I'd probably start with thinking about it in a 50-50 landscape to think about, is that the right balance as a starting point, or do we need to shift more? Is our mission more focused on places that really wouldn't get capital at all? And then we need to focus on that. Or do we need to kind of think about our own financial sustainability and the growth of the capital base to do more down the road?
I really like the point you made. We're not a foundation, so we don't have this problem, but if I were working at a foundation, I would really emphasize the fact that I would hope that, I always try to, when I speak with our sisters, remind them impact investments are not a replacement for philanthropy. There are so many problems in this world that will not be solved with impact investments and that require pure humanitarian assistance. And so to your point about you don't want to take money, the 5% that are going towards that pure humanitarian issues, I would encourage, if there's foundations in this room, that you don't take away from that. If your organization is focused on issues that are job creation and economic development that are not humanitarian issues, then I do think impact investments can play a role. PRIs have a role to play in supporting organizations. So agree with Dave that it gets down to your mission. I would also say that we've been thinking a lot too about who's making the decisions about where this wealth goes, because sometimes our sisters ask, they say, so we're giving money to these poor communities, but then they're paying it all back to us plus interest, and we're taking it all back, and we're then deciding again where to put the money. Shouldn't they just keep the money? And that is philanthropy, of course. That's something completely different. But I do think that when it comes to you're thinking about your 5% spend, it is good just to be mindful of, where is the money flowing, who's making the decisions, and what's your end mission and goal, and should this money be really philanthropic and stay philanthropic, or can you justify having it come back to the organization and redeployed?
So we have wrestled a little bit with program-related investments. We've thought long and hard about our grant making in the Porticus context, as well as the investing in the endowment context. And then you get much more into the venture philanthropic, blended finance sort of opportunities in between. And we've had great success with some of those, in particular where you're using philanthropic capital to bring in commercial capital behind you to de-risk certain things and to start certain things that then get traction on their own. But they're most often still structured as grants in the beginning, as first loss capital, or as because it's far less complex that way. One really shouldn't underestimate, at least from my perspective, the technical complexity of PRI grant making. not just in the reporting side to the regulatory authorities, but also the many hours that go into structuring the shareholders' agreements and maintaining alignment with shareholders. And in one of our PRIs, you see that people are in them for different reasons. Some people are in as investors, some people are in as, from a charitable perspective, and it can get very confused. People have different agendas around the table, and it can get very difficult. And so I would approach them with some degree of caution going forward, that you really have very clear agreements around the people around the table, and particularly new people coming in and giving money to the initiative, that everyone stays aligned on what are we doing here together and how are we going to do it.
So if you're on a, oh, sorry, go ahead.
What are PRIs? I've heard this.
So when you invest your corpus, your endowment, in mission-related investments, that's called an MRI. And if you invest your 5% grant budget into an impact investment, that's called a program-related investment, or a PRI. So you kind of have two pools you can pick from to do your impact investing: your corpus, where you're trying to make a return to grow your endowment, or you can take a portion of your grant dollars. So it's MRI, PRI. So if you think about, let's say I'm on the finance council at my diocese, and I'm inspired after this conference to do some impact investing because I'm going to get bigger returns and more impact. How do you get started? What do you go do first?
Well, I'll kick it off, and you guys can add it. I think that there's been a lot of great information here today, and to kind of get things started. And I think we heard some earlier panels thinking about mission, thinking about your strategic plan, and rolling out a longer-term plan to move through that, coming back and checking it, periodically to make sure you're along that path. And just getting back to your earlier question, Tim, what's interesting about where impact is today and the options we have is that there are a lot of choices, and it isn't one impact investment isn't I guess they're not all the same, they're not all equal. You can see that by the different styles that we represent here. So for example, we're targeting a 20% plus return for our portfolio, and other impact investment strategies might just be trying to get capital back or a more nominal type return. And so I think all of those factors need to come into play, but really sitting down with the board to think about what your mission is, and also what your composition of your portfolio needs to be to achieve that, to achieve your mission and your the sustainable financial condition that you want and the liquidity that you need, all needs to be taken into account. And so there isn't one answer for everyone. I think you really have to have those kind of conversations. Mm-hmm.
Agree with all of that as the first step, and then once you kind of know what your return needs, your liquidity needs, your risk tolerance are, and you can look at what asset classes that you actually can invest in, whether you're investing in longer lockup private equity vehicles, or in the case of our congregation, what we did is we started with debt because it had a much shorter time frame. We could make loans or invest in private debt funds that had liquidity. So very tactically, I would say that if you're working with an organization that is new to this or wants to just do something to get started, I think investing in vehicles that have liquidity options are a great idea, because then you can, assuming that they don't lock up a gate or something, you can get your money out if it's not for you. Also, we started with small ticket sizes. We started small and learned as we went. Our Superior General was very much about, let's just start doing this, because you really could spend years and years and years sitting and strategizing about a perfect theory of change and what you're trying to achieve and getting the measurement right, and you can do that to infinity. And so we really just took the approach of, let's just start small, do kind of shorter tenured investments that have liquidity options, and then learn as we go. And then the other point I would say is just speak with your community members. This is the first time I've worked in the Catholic investment space. I worked at a secular impact fund before, and I have never seen such an open community. Everyone is very willing to share. I'm sure everyone in this room has ideas and can share. I am also on the board of the Catholic Impact Investing Collaborative. Every one of those members is willing to share it. You can email me, we're willing to share. There's lots of resources out there to help get you started.
So from my perspective, I always think of it as a journey that starts with responsible investing, and then you move into impact investing. So first, make sure you're doing all the basics. You've thought about screening, you've thought about proxy voting, you've thought about engagement. And then when you get to impact investing, it gets trickier, because I think you really do need to be quite focused in terms of discussion that we've had multiple times in the different panels here about what are your values as an organization, what's really important. Because I think there are so many good things that you could focus on, so many wonderful people doing great work. You can very easily start doing a little bit of everything, and I think that's a real trap, in all honesty. And I think to really, as a board, as an investment committee, boil down to what are the 1, 2, maybe 3 things that we're going to focus on from an impact perspective. And then really, that in itself can take quite a while, and I think you should give that time to settle so that it's really everyone's bought in. We're going to start here, and then we'll learn and we'll grow. And then you really have to find the resources, find the partners, find the organizations that can help you on that journey to making that reality. Because these are often private investments, these are complex investments, and you need to have the right resources, you need to have the right team members, you need to have the time and energy for this. And it's wonderful and inspiring work, but it's not as easy as choosing an equity fund. And that's something that you have to commit to also for the lifetime of the investment, and that's probably 5 to 10 years. If it's an illiquid private investment, that's a long time. And so who's going to be around to take care of that during the lifetime of your ownership of that initiative, that equity stake in many cases?
So you all do a mix of investing, some direct investing in a company that will be helping a vulnerable family or the planet, or in some cases even there's some Catholic Church investments in venture capital that are directly helping the church. Or you can invest in a manager who invests in those companies, or you can invest in a fund of funds that invests in a series of managers who invest in the companies. How do you think about assessing Catholicity and alignment in each of those 3?
I can try. It's hard, and we constantly struggle between the balance of how many layers of intermediaries to use, because the more intermediaries there are, the more people that you have to assess and vet, and you're investing in a blind pool. And so, to be honest, fund of funds are really hard for us to invest in because of that, because not knowing which fund managers they're going to select. The one fund of fund strategy we have invested in is a private equity fund that was anchored by another congregation of women religious. They seeded the fund, and I believe all of the investors in the fund are also Catholic. So we knew we were very aligned with all the other LPs in the fund. And then when it comes to doing due diligence, a lot of it is meeting people, understanding their values, understanding their business model. How are they actually translating those values into day-to-day business decisions? A lot of times we look at, this ownership structure of the companies. Where are the profits going, into who? How are they interacting with the beneficiary communities? For us, that's a huge important thing to understand in our diligence is, are they treating the community members with respect and dignity? Do they pay fair wages? There's a whole slew of things. Reference checks also are another huge piece of this in terms of understanding the values and the behavior of these organizations to make sure they're aligned with us. The list goes, I could keep going on, but that's to start how we think about it.
Well, so we have wrestled with this as well. It's fund of funds are obviously a great choice if you're a small organization and don't have much in the way of resources to pursue this with. Our own goals and our impact sleeve, again, a very small sleeve, we really wanted to try and understand impact data. Understanding your impact is very similar, of course, whether it's a grant or whether it's an impact investment. And so measuring your effectiveness as a philanthropist, measuring your effectiveness as an impact investor, they're quite similar activities. And so we really wanted to get under the skin. And what you quickly find is that most impact funds, the reporting, stays at a very basic level, which is great, and it's sufficient for most. But we really wanted to try and get deeper into our understanding of the impact that we were having and whether it was worth the risks we were taking from an investment perspective. And so that's meant that we've stayed away from we've done some fund investing, we've done some direct investing, and going forward, I think we're going to stay with the fund investing, because at that level you can still have great conversations with the general partner about how they are working with their investee companies to generate the impact that we're hoping to see. And one of the things that we've sort of taken from our own commercial activities into our impact investing is this idea of every business should really focus on just 1, 2, maybe 3 things that they're going to be really, really good at from an impact perspective, from a changing the world for the better perspective. And try not to be excellent on everything, because particularly for small companies, that's a recipe for disaster. Try and be really good on a couple of things, and for the rest, good enough is fine too. And that's something that's hard for some people and some organizations to actually deal with, because they get so wrapped up in trying to be perfect on everything. And then often the commercial aspect is the first thing that goes out the window. And so the balance of really focusing on what are we going to be good at, I've found is key. And the dialogue that can have with GPs about how are they working on that with the portfolio companies is really interesting to have, and it is very powerful.
And I'd say in terms of meeting the Catholic guidelines in particular, we spent a lot of time working with Tom and the CIS team to really think about what those were, digest them, and build a process to make sure that our strategy around impact investing can hold true to those guidelines. And it's really kind of helped inform our initial thesis and strategy in our investing approach. But we've also built processes for opt-outs if there's any question on that. So we think that has been a good first step there. But the next step is really kind of delivering and implementing on that. And we've chosen to build a direct investment only strategy. So it's a co-invest strategy that really leverages the broad platform of Hamilton Lane to allow us to invest in a broad variety of industries and geographies, and alongside other very talented managers, both impact managers and non-impact managers, and have us underwrite the impact and run our own assessment on the ESG risks of those companies, leveraging our partners. And so there's a lot of in-depth work that we do. We have a separate responsible investment committee. Leaders of our firm are involved with as well. Jackie is on that as well as myself and our head of ESG and sustainability. And in that committee, we work through issues that get into supply chain issues, that get into the externalities. You have a great story of a business that's doing good things, but every company consumes some resources and has a footprint. And so what are the externalities and risks that come with the impact? And we try to weigh and assess that to make sure that we're really delivering net positive results. And then I think the other piece finally would be that we really make sure that we have identified metrics and measurement, which we want to talk about in more depth. But identifying those KPIs, what we're focused on, helps us to really make sure that the North Star of our impact drive is really holding true, and that we're finding companies that where we can really measure and manage that impact.
So on measurement, let's talk about specific deals, right? So investors love to talk about their biggest winner, biggest impact deal. So let's talk about the winners and the losers, right? So what's the deal you did that's having the most impact, transformational impact, on either the climate or vulnerable families? And then what's the worst impact investment you've ever done, and what did you learn from it?
Wow. Jeez, who wants to take that one first?
I can start, and just one last point on your last question I forgot to mention. I'm sure everyone in this room is familiar with the Mensuram Bonam document, but they have a lot of really a great framework there that goes through all Catholic social teaching and has different questions and criteria to help you evaluate different investments. And I believe CIS did a really good webinar on that, so encourage you all to listen to that. But in terms of your question, I would say I don't think it's the only great investment we've done, but one of the best ones is we invested in an organization called Regenesis. It's a business process outsourcing company in the Philippines, and it works with women who have been rescued from human trafficking. And so they have a sister organization that's a foundation, and it provides the women with various psychosocial support that they need, mentorship, financial education, healthcare services, and then the business organization works with the women to provide them with very fair wage jobs, a very supportive environment. They have daily meditations and breaks that they do in the course of their business day, and they provide, one of their primary services is photo editing for real estate firms. So if any of you need photo editing services, you should look up this organization. I used them for my wedding. So they're one of the great organizations, and it's a profitable business, and we're getting a good return on it. But we know that the women are also being paid wages that are above average in their country and context. And I would say the worst impact investment I made was in my prior job. We invested in a company, in a fund that was very complex, a factoring fund in another country, and I don't want to give away too much information and put a bad name on them, but there was just fraud, and sometimes it's just very hard. I mean, I sat across the table with these people for a week and ate meals with them and shared stories, personal stories about our families, and they were just fraud. They were crooks, and it was, I mean, it felt horrible to think how bad was my judgment. But it was a very good learning experience, and it's just hard sometimes. You know, you try as best as you can, but there are going to be failures every now and then.
Bernard?
So the investment I'm most proud of at this point is a recent investment we made into a large onshore wind farm in Europe, the largest actually, where we're now a 1/4 investor in that. Very excited to see that actually get constructed and built into the enormous energy needs and the shift to renewable energy in Europe going on right now. It's a risky investment in the sense that it's highly dependent. Success in the long-term success is highly dependent on all sorts of transmission build-outs and electrification of transport and the demise of nuclear. So it's a fascinating, somewhat risky investment, but on the other hand, it feels very, very good to be part of the energy transition. Took a year and a half to put that together, but we finally got it done. The least and the one I'm least proud of is the basically the basis for what I was saying earlier. It was a water technology company very much focused on emerging markets and providing clean water to people who didn't have it, access to it. And it was a very compelling story, fantastic entrepreneur, it seemed, technologist, but someone who had been struggling with commerciality the whole time. And so we thought we had the right combination to move into a clear business plan and moving. But in the end, it was much more spend on all sorts of social aspects and couldn't focus on the business, couldn't deliver the business plan. And so he found more venture philanthropists to put money in, so it's still limping along, but I don't think we'll ever get the impact out of that business that we hoped we would.
Interesting. And I'll give you a couple of examples. One of our investments, our earliest actually exit in our first fund, is a company called Benevity, which is a software business, and as some of you may know, the acronym Software as a Service, SaaS company, which was actually put in place initially by Microsoft and Nike to help support their philanthropic giving efforts as an organization. So they're big global 80,000 person organizations and needed to find a way to support employee giving and also track that data and do matching grants and help to manage that in a responsible way. And what they found was that Benevity became more than that. It became a real human resource engagement tool to attract top employees and retain them and really identify what some of the real mission and values of those companies were of their employees. And the company grew to support a number of other clients from Google and Apple and big financial service companies globally, over 500 customers, and ended up being able to distribute capital to over 2 million different nonprofits. And one of the things that was so fulfilling about that, partially, other than the return was great too, but they're giving capital to places in need all over the world. So think about food banks and homeless shelters and faith-based institutions and medical facilities. And during the pandemic in particular, we saw the donations really skyrocket. And certainly, you don't know how a business like that performs in a philanthropic giving performs in a challenging time, but it was great to see that activity during that time period. To give an example of, I'll give an example of a company that's actually been a great investment, a healthcare business that focuses on treating eye disease and really delivers value to patients in particular that have macular degeneration or people maybe more of the elderly or people with other kind of chronic healthcare conditions or diabetes. And it's been a great investment and treated lots of patients. We were trying to get a little bit more data there, and I think we didn't get as much data on really, showing breakout differentiation on eye acuity scores. We think it's delivered a lot of value. It's grown successfully. It's on the cutting edge of technology and have great anecdotes. But sometimes you want more in terms of those KPIs. So that would be one that we're still working on.
Awesome. Let's open it up for questions. Who's got a good question? I know Tara has questions. Yeah. Go ahead.
We love your questions. I'm Molly from the Rascott Foundation yet again, and we have just started exploring impact investing over the last kind of 12, 18 months. And we're an organization who, legally, we need to stay in perpetuity. So we are looking for market rate returns, so not just concessionary. And what this process has caused us to have to do is really dig deep into our values, have these conversations with faith with our family, and really be asking ourselves, is our philanthropy making our investments making our philanthropy necessary? This real serious reflection point around our whole portfolio, and figuring out how to bring our investments in our philanthropy into alignment, which is something that's always been separate for generations in organizations. We had our investment committee and we had our philanthropic work. So how do we align the two? And we're looking to kind of use impact as this form of inclusive capitalism. So we're giving this social compass to our portfolio, and hopefully it's allowing us to put our capital in service of relationships. And it offers this different relationship to money, because I think when you can just look at your those quarterly reviews, you've got all these zeros after these numbers, and you lose the value and the leverage capability that those zeros can do when you look at it through this impact lens. So what I'm trying to get to is what we've learned is our relationship with our managers, impact managers, needs to be very, very, very different, because this is a long haul journey that we're on, and want to be in relationship with managers who are going to be as partners and not directing us. And so I'd love to hear more from all four of you, because I know you're really experienced in this, around what are the characteristics we should be looking for in our managers, what are the qualifications, and what are the questions we need to be asking them to know that it's an authentic relationship partnership we're going into, and trustworthy, and it's for the long haul.
Well, I'll start off. And Hamilton Lane has a big fund investing business as well, and so we really leverage that in terms and how we execute our direct investing activity and co-investing business. So we have some perspective on thinking about your manager selection and who you partner with. And I think it takes a long time sometimes to build that level of trust and comfort. And so I think you do want to start getting to know managers and meeting with them, in person. There's a lot of value alignment discussion I think that needs to happen around really understanding their strategy and what their goals are and making sure it fits yours and understanding yours as well. We've talked a little bit about KPIs and data, but I think that this is an area where more information is available today than used to be, but we have higher expectations to be able to deliver more transparency and information. I think one of the areas reasons why we think impact investing has grown is because there's more information available and more transparency. And we think that that's a critical ingredient in what we do in terms of tracking metrics and kind of holding our investments accountable to the KPIs that they're really focused on, and making sure that that information is delivered back to you, to the LP investor on a regular basis. And I think making sure that sort of dynamic around transparency and accountability and mission alignment, to me, are kind of the biggest elements. You're already starting off with identifying, what kind of return profile you want. And I think the other pieces that come into play in terms of execution get into making sure that manager has a cohesive strategy, a track record that's shown that they've done it before and they can do it again, a team that is a team that can stay together and work together over a long time. And we really look at track record and team and strategy as sort of three big kind of legs to the stool and how we evaluate fund managers. But I think at the end of the day, you're also looking for that connection to you and your mission to make sure that it's the right fit.
Do you want to add something?
I think that was wonderfully said. I think it boils down to the ethos of your manager and the dialogue that you can create with them on how they want to work, what's important to you about values, and that is something that I think CIS does very well. But there are many others that also, depending on an organization's mission, might be a great fit. And so it's about finding the managers that have that same fit with your mission, your ethos, and then working from there.
And I'll just add, of course, on kind of the more traditional fund manager selection, team, track record, experience, all of that we want to see. But then a lot of it is just a little bit of a intangible. Like I said, it's meeting people in person. It's, seeing how they treat the wait staff, seeing how they treat, the valet people, seeing how they just actually interact with people outside of you, because they're going to be there and telling you exactly what you want to hear, right? But on diligences, I often notice, how does the CEO treat their secretary, or, what have they done in their life up until this point? Like, is there any indication that they've cared about these issues, social issues or environmental issues, up until this point? Greenwashing, impact washing, whatever you call it, it's real. I think people know that there's folks that want to do good in the world, and they're trying to take advantage by, repackaging and marketing. And so it's hard to discern sometimes, but for us, we really look at what have these people done, not just in their professional lives, but their personal lives too. And we spent a lot of time working with, this isn't a fund manager, but we are looking, exploring the advisor consulting universe, and we spent a lot of time personally getting to know the leadership of these companies and the owners, and why are they in this business? And for us, it's hard to kind of put black and white criteria, but it's a little bit of just that interpersonal feel.
Tim, did you want to answer there as a manager yourself?
Oh, I could, yeah. Yeah, I agree with everything. I think it's character and intent more than anything. The comment about how they treat the waitress is how they're going to ultimately treat you. I give that advice to my 3 daughters about boyfriends all the time. And it's the same thing. Are people good people? Like, I'm blessed to work with the Sendana folks, for example, and we have tech bro disease in venture capital, where folks are really transactional, and they'll sell their mother down the river if they can make a buck all too often. And Sendana's managed to find the good people. So they're people you want to be around. They're great returners, and they build genuine relationships with their founders, and that's why, because they have character. So they're good people that fundamentally care about the founders and their mission, and they're just fun to be around. Nice people. Like, I go into the Sendana conference, so I go into this conference, right? It's just wonderful, affirming, versus some of the stuff you see. You got to find those good people and back the good people, and then when the good people win, we all win.
Maybe one last thought from all of my years picking managers. I found that if you actually, during your visit there, always visit, during your visit, ask to speak to some of the junior staff. And then you'll see how far down in the organization, what you've heard from the top salespeople, how far down in the organization does it go? And that'll tell you very quickly where you are.
Great job.